All right, what's up, guys? I hope you all are doing well. Today, I am back with another video on price action and liquidity and really breaking down why the market moves. I found this interesting bit of price action, and it is just a reminder to me that there's a logic behind the markets. It's not just random stuff, it's not just these indicators and these things like this. But if you just look at the candles and the price action and break things down, like, there's a definite reasoning behind why certain things happen. And when we can break down that reasoning and like understand the why, like I said, the how becomes much easier. So with that, let's start going over this. So this is a Euro USD. This is a 3-hour chart. And the first thing I want to break down is what I've been calling consensus candles. Now, this none of this terminology is important. Like, if I get these names wrong, a lot of these concepts I just figured out myself, so I named them whatever. But the whole point here is a consensus candle is essentially something that it's a candle that breaks a previous structure. And this right here is actually a pretty bad example of one of them because it doesn't break the previous structure beneath that. So we're going to take this one right here. So we have this candle, and I'm taking just like the wick to wick. And what ends up happening is, as you can see, we have this wick that's on top here. And this was like the ceiling of this price action right here. So that meant that there was an amount of liquidity that existed above this zone that, in order to break above this level, basically a whale had to come in. Because remember, these are like multi-trillion dollar per day markets. So the only people that are actually moving these markets are institutions. So when you have a candle like this that actually breaks the structure, then this candle actually represents a zone where institutional contracts came into the market. Now, these can be pretty accurate when you look at them in trending markets. But one thing I want to talk about is this one on the top, because the area price action I really want to focus on today is actually this, because it showed a lot of very interesting things. So, like I said, this I'm calling a consensus candle, but it does not exactly follow my rules of what that is because it fails to break this level and this structure, if you will. Um, it's not a really great structure to say, okay, and this came through and it broke it, but this was a bit of a interesting swing to like stop things out. So this is a bit of unusual price action, but as you can see over here, um, the price in this area actually very well respected what happened within this consensus candle, as with the same way that it did on this one, where it broke into this zone and then it used that because the contracts that came in here are being protected, right? If an institution's buying at a level, then typically, I'm saying typically, this isn't like this always happens, but they're not going to go below where they started buying the contracts. They might sweep price up here because then they're going to take more liquidity of people that are starting to buy, and they can sell off into that and then continue to buy more shares at cheaper prices as price goes up. But if they're not going to want to go below that level typically. So what we have up here is, like I said, a consensus candle, and we have the zone, and then the zone being respected by this area where price came up and began to consolidate. So there's a handful of things going on here that I found interesting and actually worth bringing up. So another one of these concepts, induction. And what I mean by induction is essentially for liquidity to actually build up above a zone needs to be created. So when this swung up here, and it did in fact break this high, and it created this where it's above this high, but it kind of created a zone where now traders are paying attention to this. Now traders see this as, okay, this is a swing high. And with this swing high, what happens is a lot of orders start getting stacked above this market. You can think of things along the lines of this, where you get people and they're like, oh, I want to sell, and they're putting their stop losses above here. Or you get people that they're above this zone and they're wanting to break out. They're wanting the market to break out above this. So you get like this kind of thing going on. And this is like the retail market, right? So this is how liquidity builds up. And what this induction essentially is like, okay, like a statement was made, right? Now people are paying attention to this specific area. And when this specific area breaks, all of those contracts are going to be entered into the market. And that's all liquidity for a specific direction for a market maker to kind of do what they want with it, right? So remember this idea of the consensus. So this essentially says that there were institutions that were shorting from right here. You could even see the way that there was this stop hunt coming back to the trend line that institutions were shorting right here, meaning they're still holding contracts that typically, if the price is going to move lower, then they're not going to want to buy back those contracts, right? They still want to sell at this higher price. So what happened here is we had big liquidity event go on. Okay. So beyond this induction, let's talk about this trend line. Okay. Now, trend lines are actually a really useful tool if you're paying attention to liquidity. First off, trends can be legit. Trends can be something that you can actually follow and pay attention to. But one thing to note that happens with trend lines is retail traders also look at trend lines to determine breakouts. So when again you have traders that are saying, okay, it broke the trend line, I'm going short right here, and where are their stop losses, right? Their stop losses are going to be above this zone of induction because now all the traders are saying that's the high. If I sell here because the trend line broke, I can go above this area right here. This happens like clockwork, my friends. You see this happen so often with trend lines. I mean, you could build a strategy off of this, quite honestly. It's because, like I said, as soon as the trend line breaks, traders are like, oh, it's going short. And maybe it is going short because look, in this scenario, this actually broke the trend line. It changed the trend and it's going short. But what happens is they enter too early. They enter at the retail price, not at the wholesale price. Think about that for a second. They're entering at the retail price. The market is showing me I want to buy right here. It's the shop front window. And then they're putting their stop loss right where the market makers can use their contracts to actually get a better price, right? Because everyone that's selling right here, this is a forced buy order. Okay, it's a forced buy order. Now, if the market makers want to sell in big contracts, they need people to buy their orders. Okay, so that's where we have seller demand. Okay, we have retail seller demand coming in here and actually being utilized for market makers to actually sell this off. And that's what this induction zone is. Okay, so the one more thing on here that I want us to pay attention to is these orange lines that I said right here, like these sort of footprints that are showing up. And I always think it's interesting when something like this happens. So this was the first level of demand right here, where retail traders were selling short and they're putting their stop losses right above here, maybe even some of them in here. But what happened, I'm sure some of it was in here because the market took it lower one more time. So what this essentially said is a bunch of contracts were taken right here. But look at this, how the market did not break the previous high, meaning that all the liquidity was further above there. But what they wanted was more contracts to actually be entered into the market. So the market went up to the trend line, pushed off of it one more time, dove deep, and then they basically went in for like a second helping, right? They went back to the kitchen and they asked for seconds. They're like, okay, there is more sellers down here and we are hungry for that. We want those sellers before we take all the liquidity up here and then sell off and then dump, right? So like I said, my friends, this is a logic that plays out. When institutions sell or buy, then they typically want to keep their positions at the level that they sold or bought them, assuming they were at a wholesale level, if you will. And given that, like I said, institutions are the only ones that actually have enough volume, enough liquidity to move the market, then what you see is when the markets typically move from an area, like with this consensus area right here, then the price is not going to break that. Okay, like I said, this is a typical thing. This isn't like a go bet the farm on it, but this is like when you see these kinds of zones and they line up in this way. Like even right here, this isn't a great example of it either, but you see this area right here where this specific high was breached, and then you can see these bullish candles going up through here. It would be harder in this scenario to actually break this down into like one specific candle. That's what I like. I think it's cleaner if you can find one specific candle and it looks like that. But this is what happens because you can see these areas where institutions had to come in to break the zone of consolidation, of accumulation, if you will. Because like I said, this is indecision. That's why I call this consensus. When the market makes consensus, that's because the market makers have come to a consensus as to what's happening. And then from here, you have a similar thing. You have the market exploding higher, and then you have demand for long orders. This demand for long orders, everyone that's freaking out and they're in FOMO and they're buying all their contracts up here. Look where their stop losses are. And I love how I keep putting these on here and like the stop loss just is automatically where I need it to be. But that's the idea, my friends. It's like every time the institutions need to do some sort of business, like if they want to take it long, their best idea is actually to get people involved at the retail price. So then they can sell them their shares at a retail price and then pull the market down in doing so and then buy back their shares at the wholesale price, right? The wholesale price. Because that's what we're looking at. We're looking at retails that's getting stopped out, and we're looking at institutional that is buying at the best possible price. This is why it pays to be patient and to have maturity in the market. Like I said, my friends, this is an interesting bit of price action in the way that this all played out because it's a bit complicated, but it did technically follow all of the rules except for this questionable candle, except for that. But because of, like I said, this kind of explosion of volume that happened right here, the price shifted, if you will. It's worth it. It's worth taking it because it actually showed that these zones respected it and there was a consensus here. So, with that, my friends, I hope that makes sense. Like I said, the market does have a logic behind it. And that's really what I'm trying to break down for you all here. Once you see it, you can't unsee it. So, that's what this is all about. So, with that, I hope that helps. And I wish you all well. Take care. Until next time.